Hello viewers, this is CPA Donochoy who provides session on accounting, that is to be specific on financial reporting and advanced financial reporting. The first thing I could urge you, whoever who is watching this video, subscribe to my channel. So click on the subscription button and share this video. So for today we are going to talk about the key adjustments. Which are made in consolidation. So consolidation is a topic in financial reporting and advanced financial reporting under the CPA course. So when we talk about consolidation, and to be more specific, going direct to the topic of today, that is key adjustments made in this consolidation. So the key adjustments made in consolidation. So key adjustments. So the key adjustments which are made in consolidation. So the key adjustments which are made in consolidation include, number one, we have the unrealized profit. We have the unrealized profit on stock. We have the unrealized profit on stock. Number two, we have the unrealized profit. We have the unrealized profit on fixed assets. We have the unrealized profit on fixed assets. Number three, we have the revaluation gain on the assets. Revaluation gain on the assets. On the assets. We have the revaluation gain on assets. Number four, we have the intergroup. We have the intergroup owings. Intergroup owings. Or we call them intergroup outstanding balances. So intergroup owings or the outstanding balances. So number five, we have the cash in transit. We have the cash in transit. We have the cash in transit. Number six, we have the goods in transit. We have the goods in transit. Then after talking about those key adjustments which you need to make, we have other key accounts. Key workings, or I can say key workings, other than saying the accounts. So the key workings which are done, stroke accounts. So the key workings, stroke accounts. So we have the number one account which is concerning the retained earnings, we have number two, the non-controlling interest. So the non-controlling interest, that is both for the determination of capital and the profit to the minority shareholders. The number three, we have the computation of goodwill. Goodwill. We have the aspect of computation of goodwill. Then number four, we have the aspect of determining the investment. We have the determination of investment to associate stroke joint venture. Associate stroke joint venture. So I would like to start from the first area, that is concerning the key adjustments which are made in group accounting. So the key adjustments, number one, which I've talked about, is the unrealized profit on fixed assets. The unrealized profit on fixed assets. So that one, so number two. I pardon you. So that is number two. So the number one is all about the unrealized profit. The unrealized profit. So that is unrealized profit on stock. So when we talk about unrealized profit on stock, this is whereby you would find that, for example, in group accounting, remember you will find one entity acquired another entity, where you will find, for example, A acquired B. Remember that when the parent company, which is, for example, now our A, acquires another entity, which is B. So the parent can acquire an entity between the percentage of 51 to 100%. So that other entity will be called a subsidiary to this parent company. If the other entity is acquired by the parent up to 50%, the other entity would be called a joint venture. So if the other entity is acquired and the percentage lies between 20 to 49, the other entity is called an associate. So the other entity would be called an associate. So on this scenario, when I talk about unrealized profit on stock, during the year, you will find that, for example, the parent sold goods to the subsidiary, or the subsidiary sold goods to the parent. But now, if it was, let's say, from the subsidiary to parent, or from the parent to the subsidiary, remember that that is two-way. So if it's the parent selling to the subsidiary, that is a downstream sale. If it's the subsidiary selling to the parent, that is an upstream sale. So remember that if the parent sold to the subsidiary, remember that on that scenario, the parent realized the profit because the subsidiary paid for those goods. But now you have to check if the subsidiary resold the goods it received from the parent by the end of the year. So on this scenario, I'm saying that if goods to B, it means A is a parent, B is a subsidiary. So if A sold goods to B, we have to check if this B resold all the goods it received from A. So in an exam situation, you will find that if the goods which were sold from this A to B were at a selling price of 200, then A included a profit margin of 20%. Then under B, you will be told that B sold a half of these goods. So which means that her half of the goods which A sold to B are unsold by the end of the year. So out of the unsold goods in that subsidiary, there's unrealized profit. So how are you supposed to determine that? So unrealized profit will be determined by taking the unsold goods, the profit margin times the profit margin. Unsold goods times the profit margin. Of which, if you are given markup, you have to change it to margin. On some cases whereby you will be told that, for example, you are given profit markup. If profit markup is A over B, remember that the profit margin will be A over B plus A. So you have to add the numerator to the denominator. So on cases where after you have determined the unrealized profit, and it was due to downstream sale, So remember that this profit was never realized by the subsidiary on that case, but already the parent had realized that profit. So this one means that the profit of the parent is overstated by what the subsidiary never realized, because this subsidiary never sold all of the goods it received from the parent. But remember that when this subsidiary was buying these goods from the parent was paid the entire amount plus the profit. So on this scenario, you are determining the unrealized profit on the unsold goods on the subsidiary. We have to adjust that in the books of the parent, because the parent retained profit is overstated. The profit of the parent is overstated by what the subsidiary never realized. So on that scenario, in order to eliminate the profit which is overstated in the parent due to a downstream sale, we have to debit the retained earnings account. We need to debit the retained earnings account. And we need to credit the inventory account. With the aspect of the UPS, with the aspect of the unrealized profit on stock. The unrealized profit on stock, which is the UPS. UPS. So now it was what if it was this subsidiary which was selling to the parent. Scenario whereby the subsidiary is the one which was selling to the parent, then the parent never resold all the goods it received from this subsidiary. Remember that you have to determine the same unrealized profit on stock, but now this profit, which is unrealized by the parent, under the subsidiary, it would be overstated because already the parent was buying these goods from the subsidiary. The parent paid the subsidiary the entire amount plus the profit. But now the parent has not resold all of the goods it received from this subsidiary. So which means that we need to determine that unrealized profit, then we adjust in the books of the subsidiary. So how do you adjust? How are you supposed to adjust the unrealized profit on stock when it's an aspect of upstream sale? When there is an aspect of upstream sale, when there is this aspect of upstream sale, we have to debit the retained earnings account, retained earnings account. We debit the retained earnings account. Again, we debit the NCI. We debit the NCI account. Then we credit the inventory account. The inventory account. So doing this, the parent had acquired the subsidiary. It was up to 80%. Up to 80%. So there was an upstream sale from the subsidiary to the parent. From the subsidiary to the parent. Remember that on this scenario, the NCI, the minority shareholders is 20%. Is 20%. That is 20%. So which means that for you to recognize this aspect of unrealized profit on stock when it was due to an upstream sale, of which I've given an example of 80. So it has to be shared. So whereby 80% of the 80 goes to the retained earnings account, you debit. Again, you debit 20% of the 80. Then you credit with the total amount now of the UPS, the 80. With the total amount of 80. So that is how you are supposed to deal with the aspect of the UPS. So the UPS. So you have to determine if it's due to the upstream sale or it's due to the downstream sale. So if it's due to the downstream sale, you have to adjust two accounts, the retained earnings account and the inventory account. If it's due to the upstream sale, so the upstream sale, you have to adjust the retained earnings account, the NCA account, and the inventory account. Under the inventory account. Under the inventory account. So another thing you need to know is on how to determine that UPS and the RS profit on stock, which is the unsold goods times the profit margin. So of which on some cases you could be provided with the profit markup, which you have to change it to margin. So on this scenario, like now we said, if the profit markup is over B, that is like now here it's a half. So the profit margin will be half plus 1. So this one will be a third. That one will be a third. So that is the first adjustment, which you need to know how you are supposed to deal with. So the second adjustment is concerning the unrealized profit on fixed asset. The unrealized profit on fixed asset. So for the unrealized profit on fixed asset, you need to understand that that one will be due to the intergroup sales of a fixed asset. That one will be due to intergroup sales over fixed asset. Intergroup sales over fixed asset. So you will find that, so we are talking about the second adjustment, the UPFA, the UPFA. So this is due to the intergroup sales over fixed asset, intergroup sales over fixed asset, whereby you will find that there is a fixed asset which was sold from, let's say, from the parent to the subsidiary, or from the subsidiary to the parent. So if there is this aspect of intergroup sales over fixed asset, the other entity will receive this fixed asset. Let's say the parent sold the fixed asset to the subsidiary. The parent sold to the subsidiary. So the subsidiary receiving this fixed asset, the subsidiary will never resell that fixed asset. So the fixed asset is not meant for resale. But remember, when the parent was selling this fixed asset to the subsidiary, he charged a profit. That profit will never be realized by the subsidiary because the subsidiary will never resell the relevant fixed asset by the end of the year. So which means that that profit which the parent realized, the subsidiary will never realize because the subsidiary will never resell that fixed asset. So what are we supposed to do? So to determine that UPFA, we have to take the transfer value. We have to take the transfer value. There's the profit margin. There's the profit margin. There's the profit margin. The value at which the asset was transferred. There's the profit margin. Then once you have determined this, remember that I have said if it's the parent who was selling this to the subsidiary. So remember that the parent realized the profit, but the subsidiary will never realize that profit the parent realized because the subsidiary will never resell this fixed asset. So after determining the unrealized profit on fixed asset, we need to adjust two accounts. That is the retained earnings account. The retained earnings account we debit, and that is in the books of the parent because now this profit is overstated in the parent since it was never realized by the subsidiary. The parent realized that. So which means that profit is overstated in the parent. So we debit the retained earnings to avoid the profit overstatement. We debit the retained earnings, then we credit the property, plant and equipment account. Property, plant and equipment account. Property, plant and equipment, not equity, sorry. Equipment account with the aspect of the UPFA. With the aspect of the UPFA. With the aspect of the UPFA. So due to the sale of this fixed asset, there is something which we call depreciation overcharge, which will arise. Depreciation overcharge. Because now we were talking about the depreciation overcharge. So the depreciation overcharge, it can either through taking the UPFA times the depreciation rate or the UPFA over the remaining useful life. You divide the remaining useful life. So how do you adjust this? Because they did what? They did a depreciation overcharge which understated the value of the asset. So to adjust this in the books now, for us to adjust this one, remember that they had understated the asset. They had understated the value of the asset. And at the same time, they had understated the profit. So to correct that, we have to debit the property, plant and equipment account. Property, plant and equipment account. Property, plant and equipment account. Then we have to credit the retained earnings account. The retained earnings account. The retained earnings account. So that is the second adjustment, which is always done in group accounting. So students, good students, if you could like to get more of these sessions I'm doing, to understand more about all the topics, what you are supposed to do, welcome to my Zoom classes, the live sessions I do. Like now the financial reporting, we do them on Wednesday and Thursday, 8 p.m. to 10 p.m. For the advanced financial reporting, we do them on Monday and Tuesday, 8 p.m. to 10 p.m. So if you could like to interact more, we interact more and talk about consolidation, we talk more about published accounts, we talk more about earnings per share, we talk more about reconstruction, we talk more about partnership. So I'm talking on the topics both on advanced financial reporting and financial reporting. Remember that you are welcomed to my online class, whereby we do comprehensive revision on the same. So my contact is 0728 760 546. And at the same time, to promote my content, kindly I could like to request that subscribe to this channel, share to your friends doing accounting in the universities. We have many universities, students doing the same. So thank you for your time. Thank you. And let's meet on our live sessions, and at the same time, continue watching on the videos I will be sharing from time to time.